Welcome to the Retirement Learning Lab, where we help you to navigate the journey to a secure and fulfilling retirement. I'm your host, Van Richards, and today we're continuing our conversation about getting your financial house in order. Now, if you missed last week's episode, I'd encourage you to go back and listen to it because today we're building on that foundation. You see, last week we talked about organizing your financial statements, gathering all those statements and getting them into one place. Now, today we're taking the next crucial step, creating a comprehensive financial inventory. We're going to turn those organized documents into a clear picture of exactly what you're worth and what you have to work with for retirement. But before we dive in, I want to mention that everything that we discussed today is purely educational. I'll share some insights about retirement planning and financial strategies, but nothing that you hear today constitutes investment or legal or financial advice. Be sure to stay tuned until the end of today's podcast for more information on the limitations of this information. Well, with that said, let's talk about creating your financial inventory. Let me start by describing why a financial inventory will change everything. I mean, everything. You know, there's a big difference between having your documents organized and actually knowing what you're worth. It's kind of like the difference between having all the pieces of a puzzle in the box versus actually spreading them out and having them put together in a puzzle before you and seeing the complete picture. In my 30 plus years of helping people plan for retirement, I've seen this transformation happen hundreds of times. People come to me with boxes of statements and they know they have some money saved up, but they don't know really their true financial picture. And without that knowledge, they can't make informed decisions about when they can retire, how much that they can spend, or what risk that they need to plan for in the future. You see, just recently, I had a conversation with a real estate lawyer that's been a client of mine for some time. And he said to me, Van, I went to law school and I had to be super organized. You'd think I'd understand this stuff. But then he told me, I can't know everything. That's why I need you. You see, the takeaway that I got from that comment was that there is so much information out there about retirement planning that getting help makes it so much easier, and it really makes a difference. You see, another client of mine who is a psychologist thought that she had everything under control until the financial details started to get overwhelming. She made a comparison that's really stuck with me. She said, Van, this is just like in my practice. I have patients who try to look for solutions here or there on the internet. The problem is they don't know what they don't know. And I'm in the same boat when it comes to financial planning. She said to me, I want to make the best decisions, but I don't know what the best decisions are. I don't know what I don't know. That phrase, you don't know what you don't know, perfectly captures why intelligent, educated people struggle with financial planning. Let me tell you what happens when you don't have a clear financial inventory. You make decisions on guesswork rather than on facts. You might retire too early because you think you have more than you actually do. Or you could possibly work years longer than necessary because you're afraid that you don't have enough money saved up. Let me share with you a couple of stories that have happened to me, or I've encountered, that is. These are two stories that perfectly illustrate why creating a financial inventory is so critical. The first story is about a couple, I'll call them Bob and Susan. They came to see me about 6 months before Bob's planned retirement. They'd been saving diligently for decades, as probably you have. And Bob was confident that they had plenty of money to retire comfortably. But when I asked them how much that they actually had, Bob said, well, we've got our 401ks and some IRAs. The house is paid off, and Susan has a small pension. I think that we should probably be fine for retirement. Now, let me tell you, friends, that's not a number. That's hope disguised as a plan. When we actually inventoried their assets, we discovered something really surprising. Bob was really surprised. Bob thought that they had around $800,000 saved. The reality, they had actually $1.2 million in retirement assets. Plus, their paid off home worth about $350,000 and Susan's pension that would provide $1,800 a month for life. Bob had been underestimating their financial position by almost $750,000. He could have retired 2 years earlier, or he could have retired as planned and lived much more comfortably than they imagined. Now, the second story has a different outcome. This gentleman, I'll call him Tom because I do keep all of my client information confidential. Tom was 59 and he was absolutely convinced that he could retire at 62. He'd been telling everyone, his wife, his kids, the people at work, that he was set for life. When I asked Tom how much he had saved, he said that he absolutely confidently, this is what he said, between my 401k and my wife's retirement, we've got at least $900,000, maybe more. Well, when we created his financial inventory, we discovered a very different reality. His 401k had about $380,000 in it. His wife's account totaled about $145,000, and they still owed about $125,000 on their mortgage. Their actual investable assets were only about $525,000, not the $900,000 that Tom had assumed. Even more concerning, Tom had been counting on his brother's promise to leave him some land as part of his retirement plan. Now, that's not an asset. That's wishful thinking. That was a tough conversation to have with Tom. When we looked at the numbers together, I had to show him that retiring at 62 would only allow him to replace about 60% of his current income. Let that sink in for a minute. Think about it. That's a 40% pay cut right when you stop working if you retired at 62. Tom looked at those numbers and he just had to realize that there was no way that he and his wife could maintain their lifestyle with that kind of income reduction. But here's the good news. That came out of his financial inventory. By waiting until 67 to retire, he could replace 80% of his income, meaning only really a 20% adjustment, not that 40% cut that we discovered. That made all the difference for Tom and his family in retirement. So what do we make of these stories? What do they teach us? Both Bob and Tom thought that they knew their financial position. Both were wrong. The difference is that Bob's mistake would have cost him years of unnecessary work, while Tom's mistake could have cost him his entire retirement security. This is why guessing isn't good enough. This is why creating a precise financial inventory isn't just helpful, it's essential for making sound retirement decisions. So let's get into what you need to do to create a financial inventory. Your financial inventory has three main components, and I want to walk through each one of those so that you understand what you're looking for. Now, the first component is your assets. This is everything that you own that has value, and I mean everything. We're talking about your bank accounts, your investment accounts, your retirement accounts, your 401ks, your IRAs, your home, your real estate, vehicles, collectibles, business interests, absolutely anything that could potentially be converted to cash to provide income. Here's where people often make mistakes. They either forget about assets that they have or they overvalue what they own. And that's understandable. I had a client who forgot a small 401k that they had from a job. He had rolled it over into an IRA and he had left it like 15 years ago. We found it during an inventory process and it was worth about $47,000. Now, that's not life-changing money, but it's certainly worth remembering. On the flip side, I had a client who didn't realize that his baseball memorabilia could be used as a retirement asset. Now, that's a little strange sounding, but after having it appraised, we found that it was worth about $425,000. He had been collecting baseball cards and autographed items like bats and balls for years. He had a Mickey Mantle autographed baseball card. It was awesome. He hadn't really thought of selling it, but after learning its true value, it made all the difference where he could live when he retired. Now, the second component is your liabilities. These are your debts and your obligations, your mortgage balances, credit cards, car loans, student loans, anything you owe money on. This is also going to include any ongoing financial obligations that you might have, like alimony or commitments to help other family members too. People often underestimate their liabilities where they forget about smaller debts. But every dollar that you owe is a dollar that's not available for retirement income. Here's something else that many people don't realize this. Having high debt can actually block you from one of the most underrated retirement income strategies available. That is a reverse mortgage. Now, reverse mortgage allows you to tap into your home's equity without having to sell it or make monthly payments. It can be a valuable tool for supplementing your retirement income. But here's the catch. Even if you have your home completely paid off and it's worth a lot of money, you might not qualify for that reverse mortgage or as much money in the reverse mortgage if you have too much other outstanding debt. Your credit cards, car loans, or other obligations could really disqualify you from accessing what might be your largest asset. This is just another reason why understanding your complete debt picture is so crucial for retirement planning. Here's the third component. That is your net worth. This is simply your assets minus your liabilities. Now, this number, that's your net worth. It's your foundation for all of your retirement planning. It tells you what you actually have to work with. But here's the key. Your net worth isn't just one number. Different assets serve different purposes in retirement. The equity in your home provides security, but it's not as liquid as your 401k. Your collectibles may have value, but they're not producing income right now. Understanding these distinctions is so important. Let me walk you through the process of creating your own financial inventory. If you downloaded the Retirement Life Workbook from last week's episode, or if you haven't, I'll tell you how to get it again in just a moment. You already have the framework for this process. Step number 1 is to list every asset with its current values. Go through each category systematically. Start with your cash and your checking accounts. Then move on to your savings, your CDs, your money markets. Next, inventory your investment accounts. That is your brokerage accounts, your mutual funds, your individual stocks, or your bonds, and even your cryptocurrency. Don't forget your retirement accounts either. List every 401k, 403b, IRA, Roth IRA, pension plan, and annuity that you have. Get the current balance for each one and make sure that it is current. That's important. Then move to your real estate, your primary home, any rental properties, vacant land. Get current market values. Now, what you paid for them or what you think they might be worth might be different. So make sure that you research that information. And finally, list your other assets. Remember, I talked about the baseball card collection for the client previously? You may have something like that too, but also include vehicles, boats, jewelry, art, collectibles, or your business interest. Money owed to you for anything with value. Then move on to step number 2. That is to document every liability. List every debt with current balances and monthly payments, your mortgage balances, your home equity loans, your credit card balances, your auto loans, your student loans, your business loans, absolutely everything that you owe. Then move on to step number 3. That is to calculate your net worth. Add up all of your assets, add up all of your liabilities, then subtract the liabilities from your assets. It's pretty simple, really. That's your net worth. But don't stop there. Also calculate your liquid net worth. That's an important part because you see, when you get to a certain point, and if you need money quickly, you want to know where to go to get it. You also want to make sure that you have assets available when market corrections may happen so that you don't have to go and sell investments. You want to make sure that you know what your liquid assets are. That's your assets minus your liabilities, excluding your primary residence. Now, this gives you a clearer picture of what's actually available for your retirement income. It's important to keep this in mind. When you're creating your financial inventory for retirement planning, there are some special considerations that you need to keep in mind. That those assets have special tax implications. Now, not all assets are created equal from a tax perspective. Your Roth IRA is tax-free in retirement. Your traditional IRA and your 401k will be taxed as ordinary income when you withdraw it. Your taxable investment accounts may generate capital gains taxes too, so you have to keep that in mind. And I'm sorry if I'm getting too deep into some of these things, but if you need to listen to this again, you can go back and play it again. You see, understanding the tax implications of your assets helps you to plan more effectively what you have coming in, your retirement income. There's also the liquidity considerations to keep in mind. You see, some assets are really easily accessible. I just mentioned those, but others aren't. Your savings account is completely liquid. Your 401k may have some restrictions or some withdrawal issues with them. I once had a client that I helped them with their retirement plan with their company. And the lady that owned the company was worried about employees leaving and taking their retirement account and actually being competition. So what she did is we talked about that, and she actually put a restriction on there that the money that she contributed to the plan, which was quite a bit, could not be accessed until the age of 65. So that was an important thing to consider. Your home is equity too. It's valuable, but it's not immediately accessible unless you sell it or you get a loan. Now, when we talk about reverse mortgages can actually get what's called a line of credit. That's something that you need to investigate if you need to have liquid cash available. Plus, you need to take into consideration income-producing assets versus growth assets. You see, some of your assets may produce current income. That's important, like dividend-paying stocks or rental properties. Others are going to be focused on growth, like growth stocks or appreciating real estate. And understanding the distinction between the two is absolutely crucial for retirement planning. Here's something that surprises a lot of people. Just because you retire doesn't mean that you abandon all of your growth assets. think about this way. You're planning to be retired what? For 25, 20, 30 years, something like that? That's a long time. You'll need money to be growing during those years to keep up with inflation. What cost $1 today will cost about $2 25 years from now if inflation continues at about 3%. So yes, you want current income for today's expenses, but you also need growth to maintain your purchasing power decades into the future for retirement. After all, you do want to live a long and happy retirement, don't you? I want to address something that doesn't get talked about enough. That is the stress or the contentment that creating a financial inventory can create inside of you. You see, for some people, creating a financial inventory, well, it can bring a lot of relief. Think about Bob and Susan that we talked about before. They discovered that they were in better shape than they thought. For others, it can really be an eye-opening experience, even scary. Think about Tom that I talked to you about. He had hoped to retire earlier than he actually could. Now, when we think about the reactions of both of those couples, both reactions are normal and they're valuable, even the scary one. If you discover you're in better shape than expected, you can make more confident decisions about retirement timing and spending. And if you discover gaps in your preparation, you have time to address them. But only if you face the reality of the situation today. Remember this, knowledge truly is power. You can't solve problems you don't know that you have, and you can't take advantage of opportunities that you don't know exist. I have a free tool for creating this inventory. Now, just like last week, I want to give you this practical tool to help you to create your financial inventory. If you already have downloaded the Retirement Life Workbook from last week's episode, you're all set. The inventory worksheets are included in module number 1. If you haven't and you want to listen to that episode, go back and listen to it. If you just want to go ahead and download the module, go to forms.richardsfinancialplanning.com. That's forms.richardsfinancialplanning.com. Enter your name, your email address, and click Get My Free Organizer. And then check your email for the instant download link. The workbook includes specific worksheets for inventorying every type of asset and liability, like what we've talked about. Plus, it shows you how to calculate your net worth and understand what it means for your retirement planning. Here's what I want you to do for next week. First, if you haven't already, gather all of your financial statements using the process that we talked about last week. Second, work through the asset inventory section of the workbook. Don't try to do everything in one sitting. Work through one category at a time. And then third, get current values for everything. Don't guess. Don't use old statements. If you need current market values for real estate, check recent sales in your neighborhood or use an online valuation tool as a starting point. Fourth, calculate your net worth. Write it down. This is your baseline for all future retirement planning. And fifth, if you're married, have your spouse review everything with you. Make sure that you both understand what you have and where it is. So, what will this accomplish? You see, by completing your financial inventory, you accomplish several important things. First off, you get clarity about your true financial position, not what you hope it is or fear that it might be, but what it actually is. You identify any gaps or surprises that need attention. You create a baseline for measuring progress towards your retirement goals, and then you gather the information that's needed for all future retirement planning decisions. And most importantly, you move from uncertainty to knowledge, from guessing to planning, from hoping to knowing. Next week, we're going to build your financial inventory by talking about understanding your assets, your liabilities, and your net worth in context to your retirement planning. We'll discuss how to evaluate whether your current financial position is sufficient for your retirement goals and what to do if it's not. We'll also talk about tax-sensitive accounts and why understanding the tax implications of your assets is so important for your retirement income planning. So that's all for today's episode with the Retirement Learning Lab. If you found this valuable, please subscribe wherever you get your podcast and leave us a review. It helps others who might need this information. Remember, your journey from insecure to in control requires knowing exactly what you have and what it's worth. Creating a comprehensive financial inventory gives you that knowledge. Don't wait. Go to forms.richardsfinancialplanning.com right now and download your free copy of the Retirement Life Workbook. If you haven't done it already, use it to create your financial inventory this week. Next week, we'll continue building the foundation for your retirement security by diving deeper into what your financial inventory means for your retirement. Until then, get that inventory done and remember this: the path from insecure to in control starts with knowing exactly where you stand today. I'm Van Richards, and thank you for listening to the Retirement Learning Lab.